Hey Bowtie Nation, Joseph Hogue here with Bess, the geriatric of the family. We adopted Bess from the shelter probably about 2009, when we were just going to look, because you know how that always turns out. But she stole our hearts, pushing her paws under the kennel door to begging to be taken home. That was 16 years ago, and she isn't chasing squirrels like she used to. In fact, like most of us, going out the same way we came in. She's got her doggy diapers on right now. Bess is lucky though. She's got a family that's going to take care of her through her well-earned retirement. Millions of people aren't so lucky though, with estimates for 6 million 65 and older living in deep poverty. And that number likely undercounts by as much as another 6 million people. I don't know about you, but the average Social Security check under $1,800 a month wouldn't cover my monthly supply of hair gel, let alone living expenses. And God forbid you get disabled and have to live off $1,400 a month from that program. But there are stocks that'll take care of you in retirement. Stocks you can count on to help not just pay the bills, but also grow your portfolio. I'm going to reveal those 5 stocks you can count on, plus how to invest for a retirement portfolio. First up is Northwest Natural Holdings, ticker NWN, with its 4.6% yield and 68 straight years of increasing its dividend. I highlighted NWN recently as one of the best of the Dividend Kings list, and that 68-year history makes it the longest-running dividend grower in the market. Northwest has over 165 years as a regulated utility, serving more than 2 million customers in Oregon and Washington through natural gas, renewables, and water. Now, I love the business model here because it's got that regulated monopoly for safe cash flows, plus the upside to incremental earnings on renewables and that gas pipeline asset. So it's that regulated market that has helped Northwest keep up that dividend growth, growing the payout by 2.7% over the past 5 years. And we could see that number increase with growth in earnings for utilities. And this company hits 2 of the 3 rules to retirement investing that I'll share later, so make sure you catch those. We're just getting started on our list of retirement stocks, but first, I want to thank our sponsor for today's video, Fabric by Gerber Life. Fabric was designed by parents for parents to make it easy to plan for and manage your family's financial path. Taking care of your kids' and grandkids' future is just as important as your own, and Fabric makes it easy to invest in their future with a UGMA Kids account. A UGMA account is a special investing account you can open on behalf of a minor without the hassles of setting up a trust. Fabric makes it easy to plan and invest, starting with your investing needs, how long until your child starts using that money, and how long they'll need it. UGMA accounts can hold cash, mutual funds, stocks, and bonds, and proceeds can be used for so much more than similar accounts like a 529. You can use the account while they're still minors to pay for education, summer camps, and sports, or anything else benefiting them. And when they're adults, they can use it to buy their first home or to start a business. The best part is these UGMA Kids investment accounts carry special tax benefits. The first $1,250 income on the account each year is completely tax-free. The next $1,250 is taxed at the child's rate. Fabric also has gifting links that can be shared with friends and family to help grow your child's investment. There are no contribution limits or commission fees, and accounts are SIPC insured up to $500,000. You can learn more by going to the link here, or I'll put it in the description below. Start investing in your child today. Go to meetfabric.com/Joseph. That's meetfabric.com/Joseph. Back to our list, and one to help pay the bills in retirement. The Alerian MLP ETF, ticker AMLP, with its 7.8% dividend yield. The fund holds shares of 14 companies in the midstream segment of the energy market. Those companies in transportation, processing, and storage. These are strong cash flow plays because the companies get paid on that volume rather than the oil prices and pass on most of their profits on to investors. As a fund, it's diversified across every step in the midstream segment and holds the best companies in the group like Energy Transfer and DCP Midstream. Best of all though, it's a way to invest in these companies without that annoying K-1 tax form each year. Here's one of my favorite real estate stocks and a crucial part of the 3 rules I'll outline next. WP Carey, ticker WPC, with its 6.2% dividend. I've owned shares of WPC for years, so it just shows these aren't only retirement stocks, but solid investments for any investor looking for that strong cash flow and the upside potential. WPC is a $13 billion real estate investment trust, a REIT with almost 1,300 properties across 170 million square feet. And the reason this makes so many of my lists is its diversification. First, the company's real estate is spread across multiple property types. About a third of the rents come from those industrial properties, with another third in warehouses. But then you've got this 21% from retail and another 15% from those other types. So a crisis in any one property type isn't going to kill the company. WPC is also the most geographically diversified REIT I've seen, with a full third of its rent from properties in Europe, to smooth out that focus on U.S. real estate. And so it's that diversification across property type and location that makes WPC one of my favorite REITs, really reducing your risk in real estate, but keeping that high cash flow potential. But then if we look at the fundamentals for the company, especially those around the funds from operations, and remember that FFO is what you really need to be following with real estate stocks because it backs out that massive depreciation expense that skews earnings. But if we look here at the NAREIT REITwatch monthly report, we see WPC is only expected to grow its FFO by 1.9% over the next year. That is above the average for its group, but still pretty anemic growth. The company is already paying out 62% of its FFO to cover that dividend, below the average for its group, which is good, but still doesn't leave a whole lot of room for growth if it's not growing that FFO. We've still got 2 more stocks to highlight, stocks critical to your retirement peace of mind, but I want to show you what to look for here, how to find these stocks for your retirement portfolio. More important than the stocks I'm highlighting in this video are those 3 rules that are going to make sure your investments last and keep you out of poverty. The first rule here is just to hold different assets. So you want funds that give you exposure to bonds and real estate as well as just stocks. That can mean individual real estate companies like WP Carey or an ETF holding lots of them like the Real Estate Sector SPDR, ticker XLRE. And the second rule for retirement investing, even in the stock portion of your portfolio, focus on dividend-paying stocks and companies within safer sectors, like utilities and consumer staples. And I know those utility stocks or the consumer staples names, just like the bond portion of your portfolio, aren't going to surge higher making you fast money like some of those tech stocks. Folks, it can be dangerously tempting to say, well, hell, I got started late and I don't have as much as I need to retire, so I need more risk, more tech stocks to make up for that lost time. But nation, think about it this way. If you're withdrawing about 6% from a $150,000 portfolio in retirement, yeah, it's only going to be about $9,000 a year, or maybe $750 a month to help pay the bills. It's not much, but it helps, and that portfolio should last at least a couple of decades, even at that rate. But now, what happens when a crash hits in the first few years of your retirement? If you're almost all in those risky tech stocks trying to make up for that lost time, your portfolio could lose half of its value. Now trying to take out that same $9,000 a year to help pay the bills, that is 12% of your lower $75,000 portfolio value, and it is not going to last. So those first 2 rules are about safety and making sure your money is there when you need it. The third rule of retirement investing is about putting more cash in your pocket with dividend growth. And that means investing in stocks with a history of higher dividend payments, like those in the Dividend Aristocrats group with a 25 plus years of dividend growth, or those in the Dividend Kings with more than 50 years increasing their payout. Next here, giving you the safety of bonds, is the iShares Investment Grade Corporate Bond ETF, the LQD, with its 4.3% dividend. As a bond fund, most of your returns is going to be in that dividend, with maybe a 1 or 2% more a year. But this one is all about that safety in a stock market crash. When stocks crashed 50% in the 2008 financial crisis, this bond fund held on, only falling 13%, basically flat after the dividend yield. This all means if stocks do crash during your retirement, you're going to be able to spend down the money in your bonds while giving the stocks time to rebound without having to sell out at the lows. The LQD holds over 2,800 bonds from some of the largest companies like JP Morgan, Verizon, and Oracle. These are all high-quality investment-grade companies with the highest credit ratings in the market, making it one of the most dependable bond funds. Our next retirement stock is one of my favorites with a history of dividends and price upside. But if you're looking for those dividends that won't let you down, there is no better place than the Dividend Kings. Stocks in this exclusive group have increased their dividend payments for 50 or more years, some of the payouts that have stretched over a century, and I found one of the best among them, the one Dividend King to rule them all. So check out this video here and find out what that is. But don't think we've forgotten about tech completely. And International Business Machines, ticker IBM, with its 3% dividend, is going to do 2 things for your retirement portfolio. First, shares of the tech company have stronger growth potential than those utilities, bonds, or consumer staples that make up much of your retirement portfolios. That's an important source of growth to offset that spending down in your portfolio in retirement. Also, though, IBM, as an older tech company, gives you the stability and cash flow that you just don't get with other tech stocks. After years of struggling results, IBM has finally leveraged more than a decade building its AI services, and is now capitalizing off that with a 35% return this year alone. Get started on your kids' future with a kids investment account and Fabric by Gerber Life with the link in the description below. Or click on the video to the right to see that full list of Dividend King stocks, increasing their dividends for more than 50 years. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.